Investing can seem really complicated when you're getting started. There are so many things to learn and think about before you even start putting money into a brokerage account, and even more when you need to make decisions about which stocks or funds to invest in, when to sell them, how much risk is appropriate for you. The list goes on and on. A lot of beginner investors get scared away by the mistakes they find themselves making. In today's video, we're going to be taking a look at 7 of the most common mistakes that beginner investors make. If you learn from them, you might be able to skip over the beginner stage entirely and jump right into being an advanced beginner. Welcome back to Coach Stack, your secret weapon for improving yourself through business, investing, and personal growth. Be sure to hit that subscribe button and notification bell so you don't miss out on our next videos. Alright, let's see what we can learn. Buying high. Buy low, sell high is probably the most cliche piece of investment advice out there, yet beginner investors still get caught out over and over again. Generally, they understand the concept of selling high. All you need to do is wait until a stock price rises above the price you purchased it at, so not much to mess up there. Instead, they run into trouble with the idea of buying low. This usually comes down to jumping on bandwagons that have already left the station. If you see or hear about a stock that's generating hype due to impressive growth, it can be tempting to try and get in on the action. The thing is, many times, you may be too late by the time you're hearing about it. If in doubt, stay patient and wait for better opportunities. Not understanding what they're buying. Many beginner investors buy stocks without really knowing anything about the company. As a rule of thumb, you should be able to answer basic questions about the business history, products, and financial standing of any company you buy. Sure, in the beginning, some of this information will be completely useless to you. You need to take the time to absorb the information anyway because it creates a habit that will serve you well down the line. There might come a time when things like operational efficiency and liquidity are important factors in your investing strategy, and having a system in place for learning about companies will help you get the information you need quickly. When you buy a stock, it's good to take the Warren Buffett approach of feeling like you are literally buying the company. Imagine you were buying the supermarket down the road. You would naturally want to get in the weeds and find out everything about the business before settling and being given the keys. Not having an exit strategy. All too often, novice investors get caught up in trading without stopping to think about what their goals are or how much they're willing to lose. Taking profits at the right time and cutting losses before they get out of hand are incredibly important to successful trading. But not many beginners stop to think about their exit strategy. You want to establish upfront what strategy you are following. Are you going to be a long-term investor, or are you trying to swing the trade? If you're in it for the long term, then knowing that early will help you have diamond hands when there's some turbulence. Trusting the wrong sources. This is a pretty common mistake, especially in the age of social media and clickbait articles. It's important that you don't take the advice of people who don't understand how the market works. There are so many good resources and strategy guides out there that there's really no reason to take advice from anyone who isn't considered an expert. Your best friend who's never even opened a brokerage account might have read an article about how a CBD dog food company is about to blow up. But that doesn't mean you need to be risking your money to find out if he's right. Investing too much money or too little. Investing too much money or too little is something that tons of beginner investors do. Unless you're starting with a massive bankroll, you need to think carefully about how much money you can afford to lose if your thesis is incorrect. Especially if you are investing in highly speculative assets, you should be able to invest with confidence knowing that if you lose all your money tomorrow, you'll still be able to feed yourself and pay your bills. Most financial advisors say that the ideal trading bankroll is between 10% and 15% of your annual income. Even then, not all of that money should be used to actively invest. A significant portion of that should be allocated to less risky or less active investments like index funds. So, before you make your first deposit into your new brokerage account, think carefully about your finances and invest accordingly. On the other end of the argument, investing too little can be a sign that you don't actually have much conviction in what you're doing. Even if an asset increases by 10 times, if you invested $100, it's not going to do very much for you. You need to find the balance that's right for you and your risk tolerance. Focusing on short-term results. Everyone wants to get rich quickly. But unfortunately, that's just not how investing works, usually. It's incredibly easy to get influenced by articles or posts that claim to know about stocks with huge, immediate growth potential. These are almost always too good to be true. Trading well takes a lot of patience and research. You need discipline and patience to trade wisely and focus on long-term results, especially if you're just starting out. Investing with your emotions. Some traders, especially beginners, treat investing like it's a casino. Not in the sense that they're gambling their money or making incredibly risky decisions, but in the sense that they're getting way too emotionally invested. Casinos are emotional roller coasters, and it's not hard to see why. There's money on the line. There's uncertainty in the air. You can't shake the feeling that you're going to walk out of there a millionaire. When done incorrectly, if your goal is generating consistent returns at least, investing can give you the same kind of thrill. Trading with your emotions is almost always a bad idea. If you stay calm and collected, you'll make better decisions about your money. It's as simple as that. For starters, staying calm will keep you from making too many trades. Worried and excited investors check their stocks all the time. This usually leads them to making decisions that actually hurt their portfolios, especially when they're beginners. The best thing you can do for your portfolio after making good initial investments is forget it exists. Set a reminder on your phone to check your stocks once a week or month. Obsessing won't get you better returns. In addition, removing the emotion from your trading will stop you from making reactionary trades. Calm investors don't read an article predicting 500% growth for a certain stock and immediately restructure their entire portfolio. They say, I'll have to do some research about this, and go on with their day. As a beginner investor, you're bound to make mistakes. That's just part of investing. As we've talked about in other videos, even incredibly gifted investors like Warren Buffett make mistakes, and his sometimes cost billions. If you learn from some of the common beginner mistakes that we've talked about in this video, your own mistakes are bound to be less catastrophic. If you enjoyed this video, don't forget to subscribe to the channel. We really appreciate the support, and it'll help keep you in the loop about future Coach Stack videos. See you next time.